Self-storage was said to be recession-proof. It was one of the best performing assets with the lowest defaulting rate for almost 2 decades. But that has changed. Over the last 3 years, we've seen declines that have never been seen in the self-storage industry before. So now the question is, will it return to its former glory, or has this epic run ran its course? Is it over for this amazing industry? The story of the self-storage industry is important for all investors because we see an industry as it goes from infancy to maturity within our lifetime, and we have lived through it. The changes have been massive, but they're important to understand the cycle of assets and industries and understand what it means when you're investing within those cycles. So today we're going to take a look at this new era of self-storage investing. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others, because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it going to look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank, it's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. The first thing we need to know is we got to take this wide look at this industry and other industries, because it's dominated by essentially 3 periods. We have infancy. Now, infancy of any asset or industry, whether that's real estate or business, is simply market testing and acceptance. Does the market want this? If it does, can you make it and provide it to the market in a way that is profitable so you can reinvest that capital and keep growing that industry? Lots of products the market may want, but there's actually no way to make and create that product and give it to the market at anything they're willing to pay. And so it's just a net loss. So those never come to fruition. Lots of businesses, industries, and assets die within the infancy stage because the creators and the market can't agree on something that will actually allow it to last. Now, this is very, very important because this paves the way of what the industry may or may not look like. But once it's tested and actually proven, which can take a lot of time. This generally isn't something that we see in the world of like technology, where Instagram's created and within 3 years, we know that everybody likes it because 1 billion people are using it. That is not normal. That is very special to assets or businesses that have infrastructure that can be added on and adapted at scale. It used to be that you had to actually sell your product to individuals. Then it had to go into stores and sit on shelves, and then people had to find it. Then you had to prove that it was worthy. Then it had to go in stores across the nation. This takes a lot of time. With technology, everyone has a phone. They literally have the store in their pocket. And if proven, you can test it on everybody all at once. Once again, that is not normal. Most industries, the infancy stage takes some time. Remember though, the infancy stage is dominated by market acceptance and how it will accept it. In what way, what cost, what price, and how to deliver it. The next stage, which is adolescent, that is all about the business or the industry within that market. Why? Because this is dominated by the business model. So now that it's proven, how do businesses do this? in an efficient way? And how do they build out the infrastructure needed to deliver those products, services, and assets to the market? Now, this is where all of a sudden you see lots of capital jumping in. People are testing things because we know we can make money. This is the wild west of any phase within an industry. Capital's pouring in, businesses are fighting, new models are being tested out, and you have entrepreneurs, and all of a sudden you start to get the interest of things like big banks and what we would call institutional capital. But this adolescent stage, I think, is much shorter than the beginning or the end stage. Now, the adolescent stage, though, is where lots and lots of money is made because people are taking advantage of what is now known. And that usually means they're finding efficient ways to deliver to the market. That means they're driving down cost, all while they're finding the best customers and they're increasing profits. Now, this is a consolidation phase, meaning the people that are better, they end up buying more assets or more businesses, and bigger companies start to get bigger. That is the end stage of this adolescent phase, a consolidation. Some businesses succeed while other business models didn't test out to be as good, and they get bought up by the big succeeding business models. The ones that are succeeding, they increase their capital, meaning people want to invest in them, so they get more money to put back into that business model. It's crazy, Wild West, lots of money is being made, and it can be fun and exciting. But it also leads to the inevitable pop. You see, all this excitement exaggerates future potential and what you can make and what you can earn. Why? Because there is no known cap. Nobody knows. It's just more. And everybody is building for more. And the market is accepting it and taking it. More capital's going in, more business, more infrastructure, more everything. This is an expansion phase. People are making money just by starting companies and selling it to the successful ones. It's a reinforcing loop until the market says, we've had enough. Once the market says we've had enough, they realize we have gone past that point. We're only realizing it later, where the market's literally saying, hold on, back off. That means this exaggerated valuation, this exaggerated capital, it needs to come back down to a normal. We found it. Now we have to retreat back to it. That means the big successful businesses, they're not willing to pay as much for the other businesses. So all those entrepreneurs that started with the goal to sell, their valuations are lower. That means less capital starts to go into the industry. A reinforcing loop that actually looks like it's cratering. This is common. And we see this in lots of different industries. You can think of everything from housing to the .com. These are big national ones, but this happens in individual industries in this adolescent phase. It is very bipolar for the market. 1 minute, everyone is going to be filthy rich, and then the next minute, everyone's going to fail and you were stupid. The reality is, we're just moving into the next phase. The next phase is maturity. Maturity is defined by a few things, but principally the institutional capital. It becomes mainstream. It becomes a normalized investment where things like how much money you have, lower margins, and how efficient you are is what's going to yield. It's not outsized profits nearly as much, and those profits aren't expanding. Instead, you have to have volume and the big win, and they win big. Now, this process happens at the end of that adolescence, at that consolidation phase. You have Wall Street, big investment, and private equity that are all looking into it, saying, how do we now take this proven, tested asset, and how do we win? They start buying everything up, and because of that, the overall values go down, and that makes it harder for other people to go in. So they actually are creating this. That institutional capital coming in also props and accelerates the end of that adolescent phase. Maturity is defined by the institutions are running it. The players have been designated. It is harder for mid-sized companies to come in. Not impossible, but it's harder. Now, it's important to know that maturity isn't just overnight. It takes some time. That consolidation has to actually run out. It has to phase out. But it is very obvious that it's happening, and people don't look at the industry the same anymore. There are three drivers of each of these phases that industries go through. Now, that is actually how we know and can better understand where we're at and what the future looks like. Now, these drivers are different and they're very distinct, but it's where they meet that actually shows us what's happening and what will happen. These drivers are, first, the economy overall. Now, this is actually one of the main drivers that can push industries into their new phase. We see this all the time. The other is the asset itself, or the business, the actual asset, whether that's real estate, anything else. That is how it's being operated, right? This can be defined in innovation. This can be defined in actual ability to deliver product through some way that others can't, that changes the day-to-day operations or executing of that product or service. The next is the industry as a whole, meaning how does the market in general, the investors, every market participant, how do they see this industry and what are they doing? The industry, as you can see, will rely on the economy as well as how are these assets or businesses performing. The viewpoint of the industry attracts things like institutional capital. This sets the tone and whether people are going to buy, build, start, on and on and on. The lifeblood of the industry, although it's not even, meaning every business and every location may be different, the viewpoint of how everyone understands how customers overall are accepting these assets and businesses is defined here. How these three things meet, right in the middle, this is what tells us where we are at and what will happen. So now let's look at self-storage as an example. What I did is I compiled data to map this out and show you where I believe are the actual distinct phases and why. We look at these three things and how they interact. Mainly self-storage cap rates, ownership, interest rates, and the amount of mom and pops or individual operators and businesses. Why? Cap rates represent more of a clue on the industry as a whole. So anyone not familiar with cap rates, a cap rate is value, or how that industry, like commercial real estate, views value. A lower cap rate is actually better, a higher one is worse. So mom and pop percentages represent how much of this industry has become institutionalized. How much are individual owners, mom and pops, and how much is big capital like private equity, Wall Street, investment banks, etc. The interest rates, that is looking more at the economy as a whole. Once again, putting all of these three things together, we can really see within the self-storage industry what has taken place. Now, the adolescent age is defined here in gray. The infancy age is prior, or how we've mapped it out. You see, prior, when we look at things like percentage of mom and pops, we really can see that mom and pop percentages have gone from essentially what was over 85% up until almost the 2000s, meaning that 85% of everyone in that industry were single operators, owners, mom and pop. We can see that that changed as we went along. There's a big change that accelerated after 2005. We'll get to more of the industry and how that correlates. The next thing that we look at, though, here is in blue. This is the cap rates. This is the economy as a whole and how it views this industry and what people are willing to pay, i.e. the value placed on by market participants. As you can see, cap rates at 10 plus, that's really regarded as an industry in its infancy. You have to sell at a higher cap rate or less value because the future is unknown and that may not be a good investment and it may be more risky. So I have to get more cash flow. That goes down as investors think, I know the future, it's less risky, I'm willing to pay more, and there's more market participants. So once again, blue, we can say, represents the industry, as red represents the mom and pop and how much of a percentage is taking hold. Green represents the overall interest rate. This is just interest rates in the economy as a whole, so the economy. Third-party management begins here. Now, this is where we start to really look at things like operations. This is important. Third-party management means people that will institutionally run those assets. Of course, there was third-party management companies before this, but this is really defined as the point where institutional grade, technology-driven companies like Extra Space get involved, and then REITs, the big ones, start to jump into third-party management. You see, this is what allows Wall Street and institutional players to really get involved. They may want to get involved, but if no one's there to run it day to day, big money doesn't want to do it. And it's not okay just to have some regular mom and pop run the facility. They're institutional. They got to deploy a lot of money, and they have shareholders, investors they have to report to. They need institutional corporations to run their money. Very important. It also represents the adaptation of technology into the industry. Competition starts. They are using technology in order to compete. You have to too. This represents the asset in operations. As we can see, the overall layout of this industry prior to 2005 is really defined as above 70% mom and pop individuals. It's also represented in an economy which has interest rates that are largely above 4%, as well as, prior to this, non-institutionalized, non-technology driven third-party management and valuations that were high. After this point, it changed and changed rapidly. As institutions got involved, technologies got involved, mom and pops started to get less and less and less. Now, this was offset, though, by something else that was happening, and that was a building frenzy. So that building frenzy actually stabilized. People were jumping in and they were building new assets. So though consolidation was happening, people were still building and they were starting up businesses. Why? Because the value is dropping. So they could build and sell it and make a lot of money. This is that adolescent phase. It's boom times. Returns are getting better and better, both internally. They're getting more efficient, revenue's going up, we can charge higher rates, but also values, what people and investors will pay, are dropping. Now, as you can see, this frenzy led up to 2022 to 23 and 25. This is what I referred to in 21 and 22 as the self-storage bubble. So I started talking right about here about what I called the self-storage bubble. Now, you can see that in different things like our Twitter and white papers that we wrote, and we've shown some of it here. But that is a catalyst. That popping, when this market was overdone, it was overbuilt, there was more investors, everybody was making money, was broken. Why? Due to interest rates. Values went up. The same time mom and pops have been consolidated, that actually didn't stop. This spread here is defined as a maturing industry. As you can see, that spread had basically been in reverse. Now, a maturing industry represents institutional players, which this will continue below 50%. Although values will stabilize, mom and pops have gone down, interest rates, even though they're going up higher, valuations, particularly in certain markets, have stayed competitive, accelerating that consolidation because only the big ones can pay at those values. This will continue. It's more expensive to get in, operations are thinner, and the people that are paying are less. That means valuations overall are less, while valuations of the best assets in the best markets are still incredibly high, spurring that consolidation. And that's what leads us to a maturing industry. Once again, it's not overnight. This is the start. 50% of this industry is still mom and pop. This was a feverish point. You didn't even have to know anything and you made money. The market just gave that value to you. That does not exist anymore. You just can't simply own something and make money off of it. That doesn't exist in a maturing industry. You have to know what you're doing, you have to not make mistakes, and you have to do it right. Because you're not going to be bailed out by the market. This is healthy and this is good. This can cause chaos, and it did, especially towards the end. So now, what is the future of storage? The future of storage is lots of money, but not to just everyone, to people that actually know what they're doing, and people that know where to find opportunity. It is not just a market that rises and everybody makes money, no matter how many mistakes you make, whether you have a bad location, nobody cares, they just pay you. It's a more efficient, normalized market, which is good and healthy. Now, as we can see, when you look at the sales volume by property, industrial / self-storage really after 2013 started to grow. Now, this is that big end of the cycle that I was talking about. Before, even before 2005, it was almost not represented against apartments, offices, strip centers, and malls. It literally was not even on the map. Whereas towards the end of this cycle, it is eclipsing some of those other industries completely. The future of storage will be more like institutionalized assets like apartments, offices, but it's not there. You see, apartments are 85% institutionalized. We're talking about private equity, big groups, and not mom and pops. Still, 50% of self-storage is, so this consolidation will continue. It will be defined on the individual basis by operations, technology driven. We're talking automation and optimization. Those are the business models that will win because the business models changed and we know now. You have to drive down cost, you have to increase rent. We're talking revenue management, all things that I teach and we share. The next thing is markets. Some markets will do better than others. There will be a spread, and that will be predicated on acceptance of the market, meaning you can have overbuilt markets. It didn't seem that anything could ever be overbuilt for a long time, and everybody just made more money. Those things are gone. That's not a bad thing. We believe we have 5 to 10 years left until it is acting much more like a mature industry, like its other asset classes, apartments, and so on. It will consolidate continually. More and more of the defined way to do business, which is driven by the customers and technology, will be set in stone. There will be less to innovate. There will be more execution. Now, I hope this makes sense in the future of self-storage, but to every industry and how it works when you are investing, whether that's a business or an asset. So if you want to see more of the data, this is a large presentation that I condensed, make sure you sign up for our newsletter so you can learn more about economics, industries, investing, and self-storage.